Hey friend, Steve here with IBC Global. Today, I'm going to go over how you can use a whole life insurance policy to buy real estate, and we'll look at numbers that we recently presented to a client. So the situation we have is someone who is interested in getting a whole life insurance policy, specifically to invest in real estate. So the real estate he looks at, he knows that he can earn an 8% return somewhat easily. He feels good about that. The purchase price that he's looking at in his area is around $500,000. So what he is interested in primarily is if using a policy is going to produce him a higher overall return than just using cash. Because if he just buys the property for 500 grand and he earns 8% on that, that's $40,000. So if I'm him, the question I would ask is, if I first put $500,000 into a life insurance policy and then borrow that $500,000 out to invest in this real estate, are my net returns going to be higher or lower? And the answer to that question is, it depends on the timing. Because if I do that right away during the early years of the policy, it'll make the returns worse. But in time, it will get better. So let's break this down into steps, shall we? We'll break it down into 3. The first step is getting the life insurance policy right. If we don't get the actual policy right, we will have buyer's remorse. This is the most important thing. So when it comes to the company selection, that's pretty easy. I always recommend the 4 major mutual companies, who are MassMutual, Guardian, New York Life, and Northwestern Mutual. And I would want the policy designed with a minimum base premium and as aggressive as the company will allow me to go on the PUA rider. But in his particular case, what he wants to see is moving $500,000 into the policy, but he wants to see what it looks like if he does this over 10 years versus over 5 years. And specifically, he wants to know which one is going to give him more money. So we can maximize the value of the policy just by funding the product differently. That's what he wants to see first, and then we'll progress into using this for the life insurance, or for the real estate, that is. So let's start with the policy options we looked at. Option 1 is a Guardian 10-pay product funded over 10 years. What we have going on specifically is as follows. What do you notice here? The funding is $70K per year for the first 5 years, followed by $30K per year for the next 10 years. Over the 10-year period, it's a total of $500,000. What is highlighted in yellow represents the break-even point, which is year 5. By the 5th year, he's paid a total of $350,000, and he has $350,000. The annual yield represents the true net growth rate on a year-to-year basis, which in his case peaks right around 5.25%, and that is based on their 2025 dividend interest rate of 6.10%. These are the exact figures from the illustration. Next, we're going to look at the exact same product, but funded more aggressively. He specifically asked for this funding because he knows that he can start it with a lump sum during the first 2 years, which is really the first 12 months, because he makes the first payment today, and then 12 months later, he makes the second payment, and he's got the cash on hand. After 5 years, he never pays another penny into it. He can if he wants to, but he wants to see 500 going in and then stopping altogether. Break-even point, same year 5. The annual yield is about the same when we look at it. Peaks at right around 5.25%, just a touch higher. But if we want to see the true difference, here's what I would do. There you go, cash value difference. How much more do I have in cash value by funding it over 5 years versus 10 years? And when I see the difference, is it worth it? In this case, I would say yes. By the time I'm 70, it's more than another $50,000. Now, some people look at that and say, hey, that's not enough. There's other things I'm going to do with the money. But the point is, it's always valuable to look at those options. This way we don't pick one and then find out the other one looked better after we started the policy. That's never fun, is it? So what we've got here is the 5-year option, the one that he selected. Step 2 is now using that policy, specifically loans, to purchase the property. So what we're going to look at is as soon as he's able to pull $500,000 from the policy, we'll look at a policy loan, and what we'll measure specifically is the cash value growth. So we'll call this CV growth, and we'll compare that with the cost to borrow, which we'll just call loan interest. And what I want to know if I'm doing this is what is this dollar figure compared to this dollar figure? And I want this one to be higher, because if it's lower, especially if I'm told it's higher and then I find out that it's lower, I feel like this, which we don't want this to occur. No. So let's take a look, and then we'll progress on to step 3, which is adding in the real estate investment. So loans can always be run in the insurance company software. We also have a pretty cool loan workbook, which breaks down exactly what I'll pay in loan interest and also accounts for the cash value growth as well. So if you are new to cash value life insurance, a feature that a lot of people like about it is the fact that once a dollar passes through your cash value, you continue to earn dividends and interest on that. Meaning, when I look at this annual yield on cash value, I am going to continue to earn that annual yield or very close to it. Some companies practice what is called direct recognition, but that does not make that much of a difference when we look at the net numbers. Regardless, I'm going to continue to earn a return on my entire cash value, even if I borrow against the policy. So the money continues to compound for me. This is why he's attracted to it. So let's take a look here. We've got the maximum loan to the right. This is 95% of the cash value to the left. He wanted to take a loan of $500K as soon as he could borrow that. So in this example, it's at age 55. You can borrow much earlier, but we're going to keep this simple and look at a $500,000 loan. So he takes that $500,000 loan. Okay, let's take a look. 500K loan gives me a $500,000 balance. The loan interest rate with Guardian is 5%. If I don't pay the interest when it's due on the anniversary date, it's 5%. If I do pay it, you'll actually see that it's 4.76%, which is nice, a nice little discount there. That's if I pay it in cash. But here's really what I want to look at. Here's my cash value growth. This year, with or without the loan, it shows $22,600. If I borrow $500,000, it costs me $25,000. So what this means is I have a loss of about $2,400. Now, what happens if he borrows earlier than this? Let's say up here, he borrows $350. $350 balance, 5%, cost to borrow, $17,500. Cash value growth that year, $10,650. Loss, $6,850. What this column is meant to show is your cash value growth, what you're receiving from the insurance company, your annual interest payment, what you pay to the insurance company in interest, and then the spread. Simply put, am I positive or negative? So what we want to look at here, going back to the $500K loan, is this. He stops paying at this point in time. A lot of people like the idea of stopping payments early so they can just focus on repaying the loan. That's what we're doing here. So now he's going to redirect cash flow toward paying that policy loan. He's paying $25K toward the interest. What we'll do for the sake of simplicity is apply another $50,000 toward the principal. So back to this, we can see what I'm getting versus what I'm paying, and then the net spread. If I just pay the interest indefinitely, I see that I do come out ahead in this example because the cash value growth is exceeding that annual interest cost. Why I'm negative initially is because I took a maximum loan and I'm paying 5% on the full 500 and I'm earning about 4.5 on my cash value balance over here. So it's very close to a wash, but I am negative. So let's look to repay this loan. And we're going to look at step 3 here. What we're going to pay it back with are the returns from the real estate investment. Repay loan with real estate return. We can do that because we bought the property in cash. We took a loan against our policy, paid for the property, and now we don't have to pay a bank or deal with any of that nonsense. So we're going to take the full 40 and repay the policy loan. Now I know that it might be less with property taxes and other expenses that always pop up. I'm trying to keep this example simple though. Okay. So here we go. Let's take that 40K per year and apply it toward the principal. 40 and the last year is 20. There we go. So what happened here? As I pay that principal, I see the balance come down, which results in less loan interest every year. So what's happening here? Well, my spread is getting more and more attractive. What is he actually earning in terms of a return? Well, he's getting his return on the real estate, which is $40,000 plus the policy spread. That's what I would look at here. So this would be RE, real estate return, and then we want net spread. Pretty fun, right? And basically, I just want to see if my net spread is higher than just the real estate return. That's what I'm looking at here. So in summary, what happens with most real estate investors when they look at this, they say, okay, long-term, this strategy works. I see the numbers. They can talk to our clients, people who have been doing it for a long time, and the numbers do work. The hard part, I call it the catch, the early years. Because if I just start a policy and don't touch it, what happens? I'm negative during the early years. If I go back to the illustrations, it takes 5 years just to break even. So I've got the negative hit. If I borrow against my policy, in addition to that, I also have the loan interest. So that's where the pain is inflicted. And we have a lot of clients that do that. The thing that we like to look at there is I'll include another column that shows the total loan interest. This way, they can see the total loan interest they've paid over time, compare that with a total gain on cash value, and see the spread in that regard too. But for those that want to borrow very early on, we want to see that. Because yes, it's not attractive for someone to see. As an agent, I might not want to show it. I'll always show you it, but I might not want to because it's not attractive. It could make people say, hey, this isn't for me. But at the same time, I'd want to see it if I'm considering a policy, which is why I think it should be shown in that regard. So looking at that kind of stuff up front shows the drawbacks. And if someone looks at that and says, okay, like it's a minimal hit, or I am more than comfortable with it, no problem, especially when I factor in the long-term benefits, it's worth it. And that's usually the process. We start by looking at different products, going over flexibility features, different companies, designs, more cash value up front, more cash value long term. Then we look at borrowing against the policy. We'll typically run illustrations in the software itself. That loan workbook you just saw, that's something we provide to our clients. This way they can actually play around with the numbers and they can take a hands-on approach so they can look to see what would it look like, just a 95% ballpark answer, so I don't have to ask for illustrations and wait at least a day, maybe longer, especially if it's a weekend or something like that. And then see what it looks like when I repay the loan and see the money in motion and such. So with all of that said, I hope that you enjoyed this video. If you'd like to see another video that goes over how you can purchase larger properties, specifically commercial real estate, you can check out this video here.